The last section of our little chunk on insurance is covering, of course, the most important asset, or as my teacher in college said, asset, and that is you. So that's looking at life insurance. And life insurance is one of those things that's people don't like it. We're talking about death and dying, which is never a, you know, enviable, positive subject. And it's also one of those things that you kind of feel like, gosh, I'm paying insurance for my car, for my home, for my for my jet ski, for my, this, that, blah, blah. I don't want to have to pay anymore. And so a lot of times life insurance gets shoveled under the carpet. It's something you'll deal with later. It's something that you think, I don't need that. I'm too young. Um, all those things can be true statements, but we're going to try to approach it on why it is you need life insurance and how important life insurance can be when you're trying to plan your finances and cover your assets, so to speak, and cover your lost income, cover your lost wages, make sure things are paid. There's a lot of ways you can approach life insurance. It doesn't have to be $1 million policy that when you die, everybody becomes a millionaire off of you. You can choose policies as low as $100,000. Some are as low as $50,000. You may have it at work, a group policy. So there's a lot of options out there for us to look at and why it's important. So, what is life insurance defined as? It's basically a person purchases a policy, you pay a premium, and the insurance company promises to pay a sum of money at the time of your death to who you designate as a beneficiary. We'll get into that and why that's important. And then there are policies out there that are called endowment policies that may pay out a sum of money to you while you're living. One could be you reach a certain age that the policy is not going to cover that age anymore. It used to be age 100. If you hit 100, your birthday gift was, your $100,000, $500,000 life insurance policy paid to you in full. Um, they also have options in policies now. If you are diagnosed with a long-term illness or have something like that, you can take some of the value out to help pay the expenses now while you're living. And sometimes they sell just a true endowment policy, which means you're paying in and it's going to pay out while you're living. So, a life insurance is a legal and binding contract, which means there's an offer, which is them telling you, the insurance company telling you what you pay. There's acceptance, which you're agreeing to pay that. There's also paperwork that's filled out, and you sign your name. And then the policy is a legal and binding contract. So it does fall under parameters. There are legal ramifications for both. Um, when you buy a life insurance policy with a company, it's kind of like your bank account, I guess, is the best way to look at it. You have a bank account, you have money that's yours, um, especially a savings account. Let's do savings account. Sorry. If you have a savings account, the money's yours, etc. You're earning interest on it. Now, if you walked in and told the bank, I want to see all the money in my account, they can show you a printout, but they're probably not going to pull out a drawer from the vault and it's going to say on there, this is Robin's savings account. Here's your money. Um, a life insurance company is the same way. You have a policy, you have a value, you're paying a contract, but they're lumping all that together to try to make the best return on your money, especially if you're getting cash values. And they're also trying to be sure they have enough money to pay out all the claims that they're agreeing to. There are actuaries, and if you're going to be an actuary, uh, bless you, and I praise you, and I think the world of you. We use them in defined benefit plans, and then I know they work with all the insurance companies to try to figure out, if you're 18, what's your risk of dying by the time of 35? Probably pretty nil. But if you skydive for a living, or you join the 82nd Airborne, or there may be something that increases your risk of that, and so they look at all those things when they give you what your premium is. They want to make sure they can pay that out. Under the policy, they promise to pay the lump sum of money, and then of course the insurance company makes a promise to do this because you're paying the premium. When you think of life insurance, you think, well, why would I need to have it? My philosophy on that is, if you have debt, there's not a magic number, but if you have debt, let's say you just have credit cards. That's fine. Are your credit card balances $1,000? Are your credit card balance $10,000? Are your credit card balance $15,000? Reason I'm saying that is, if something should happen to you, your beneficiary, your family, your spouse, your friends, whoever you leave as your beneficiary, they're responsible for paying those things off. Now they can set up payment plans. They can do some things. Some credit card companies expect payment in full at the death of the decedent. We ran into that with my dad. American Express required death payment in full. Um, Sometimes they'll let you continue it out. Did one, it, so they'll just let you take over the credit card for payments only. You can't charge on it, but they'll let you take over payments only. Sometimes they'll, you'll have some things there. So maybe if you pass away and you're leaving it to your spouse, it's not a big deal for them to continue payments and get that paid off. If they're requiring it paid off in full, that could be a big chunk of money they have to come up with. It gets greater as you add debt to your financial planning. So if you have a house that has to be paid off, if you have a car that needs to be paid off, and it's not that you have to necessarily pay those off when somebody dies, it's just that the payments are still due on that. And if you live alone and you have a home and you have a vehicle, whoever is your loved ones left behind are going to have to probably not keep your house. They're going to need to sell it, and probably not keep your car. They're going to need to sell it. So if that's the case, they've got to pay those things off and or sell them for a premium. But payments are still due. So it just having life insurance helps them not have to dig into their pockets to pay off the things that are your losses and your loans. Proceeds are typically used to pay off a home mortgage or other debts. A lot of times, especially with married couples, and this is how we set up ours. Um, we've got insurance on both of us that will over and above now because our house is paid down quite a bit, but that would pay off the home. And that way, even though we've lost an income wage earner, um, that debt is taken care of. And so sometimes home mortgages will ask you to have life insurance on it for that reason. But anyway, at least that debt is taken care of, paid off, and so you don't have that house payment for those that are left behind. Same thing with automobiles. You may have enough to pay off your car. That way, they don't have to make the payments. That's taken care of. Sometimes they'll set them up to pay to children. They'll have it set aside for school or for education or college funds. Of course, if you've had medical expenses prior to passing away, having some chunk of change could help pay those things off too. And it can help with funeral costs. Funerals have gone through the roof. And so they can be extremely expensive. They're kind of like weddings. They can be very expensive to try to pay out of pocket. So knowing that your family has got some money coming in to make those decisions for you just helps them to know that you're not leaving them with a huge burden when something happens to you. If you've got everything taken care of, you've got money to cover everything and it doesn't matter, you might want to have life insurance set up for charitable donations. We have a client that they don't have any children. So they make sure on their life insurance that everything's paid off, anything that they owe or that's due or anything like that. And then the balance they're leaving to a charitable organization. So, of course, purpose of life insurance. Well, what's the purpose of it? You can have it set up for retirement income for those that are left behind. You can have it set up to accumulate savings. You can have it set up as income to your survivors because they've lost your income. If you're the major breadwinner, that could really help. Back when estates were taxable at $1 million or above, it's I don't know, like 25 million or something now. It's a lot bigger. It's not something most people run into at this point. But when it was $1 million or more, people ran into an issue with estate taxes pretty quickly. Because if you have a home and you think how homes have valued, they had a nice big home and now it's $650,000. They have a couple of cars, they're 20 or $30,000 each. All of a sudden, they're at like 900,000 dollars pretty quickly. Then you add in the other assets like belongings, cash, etc. And a lot of people hit $1 million pretty easy upon death. Because of that, the way estate taxes work is anything over the um, estate tax limit is taxable to the beneficiaries at a 50%, 50% tax rate. So life insurance had a big boom in selling back when that was the thing because a lot of people, as I said, hit $1 million very quickly, and so their beneficiaries were going to need tax money. Life insurance is paid with after tax dollars. It comes to your beneficiaries or your estate or whoever tax free. So that gave them tax free income, didn't get added into the estate that they could pay those taxes on and not have to come up with the cash themselves. So that was a real benefit for that. Like I said, estate taxes are now much larger, and that's not a big issue. But sometimes it's still nice to be able to leave behind non-taxable income for your beneficiaries to pay whatever should happen to come up, or just put in savings. Um, the principle of life insurance, as I said, there's the actuaries off. I always envision them with pin pocket protectors, calculators, uh, pens or pencils behind their ears, and they're looking at reams of paper. It would be now on computer screens, I know. That it used to be on paper. There were massive books that you could get that gave you all the risks. If you'd follow an 18-year-old male, and I'm not picking on you guys at all, join the military, working in, going to become a 82nd Airborne during a wartime. All those things are adding to how much your insurance could cost. So that 18-year-old's insurance might cost different than the 18-year-old who's going to go to college. So that person's got to figure out for the insurance company, what's it going to cost us to cover this person, and what is the risk of them dying before we've collected enough to offset? Will we have to pay this out early? Is what they're always worried about. So they're looking at mortality tables. They're looking at how soon people die, if you fly a plane. Usually for things like that, if you have a high risk sport or leisure time activity like flying a plane, bungee jumping, skiing, the Matterhorn, those kind of things. They ask questions on the insurance application, and they'll still cover you, but they may add a little extra premium to cover that because that's considered high risk. So they look at how much mortality tables are for different groups, different sexes, different ages, and different professions. So they look at all those things, trying to come up with the projection. We're living longer now, so that's threw all those old original tables out the window. Needless to say, they all had to be updated because I think, back in the 40s and 50s, average lifespan was about 65 to 70. So now that we're living to 110, it kind of changes that. So they're looking at that. Women also outlive men 90% of the time. If you have good health care, good doctors, everything else, they look at those things. This was given in the book as life expectancy table. This is not written in stone. So if you see your age on here and think I'm only going to live, whatever, don't panic. But basically, of course, if you buy, a lot of parents used to buy life insurance policies for their kids when they were born because it was like minuscule affording payment, but it also gave them coverage if something should happen. And it was something they could carry with them, kind of like the new investment plans for children born in the next couple of years. It was gave them something that they had when they started out. They had a life insurance policy, probably wasn't huge, but they had something out there, so they would have that to start on. Basically, they're saying if you're 20 to 25, they planning on you. If you're a guy, living another 54 years. If you're a woman, 60 years. You can see that big difference. 25, they're expecting a male to live another 45 years, a female to live another 50 years. So this is just the expectation tables. This is not your future predicted. This is not tarot card reading. I'm not a palm reader, so this is no specific projection for you. This is just giving you an idea of what they're looking at. So when you're applying for a policy, if you're 20 years old and you're a female, I'll pick on the women now, they're expecting you to live 60 years. So they're calculating that in their calculation. They're expecting to get 60 years of premiums out of you before they have to pay. That helps them figure out what to charge you now to then pay out in 60 years. So that's where that comes into play. Figure out what your needs are. Do you have a need to protect your someone financially, your spouse, your children, your parents? Um, of course, when I got my house and I was single, I bought life insurance immediately. Duh. It's my thing, it's my field. But like I said, it scared me to think that if something happened to me, my parents were left with my mortgage trying to either pay off the house, keep the payments going, or whatever until they could sell it. And depending on what the real estate market is, they could sell it the day you die, or they could sell it 6 years later. I mean, So that gave I felt like that didn't leave them with an unexpected burden, in doing that. So I was trying to think of them also. Of course, your needs may change as life goes on. You may start out, you don't think about it, of course, because there's just you. Who cares until you start getting a sizable debt like a home or something. But then when you start having children, if you have children, that maternal paternal instinct kicks in and you start thinking, "Oh gosh, now I'm responsible for not only my better half, but also my child or children." So that can make a difference when you think that insurance is important also at that point. Okay, so think about this. If you're trying to figure out what you have, do you have any debts? Do you have a car, student loan? That's a big one for a lot of people. Credit cards, pets, you want to be sure your pet's taken care of. Loved ones that you want to be sure have money. If you have yes to any of those above, figure out what the total amount is that you owe on your car, your student loan, your credit cards. What does it cost to keep your pet in its food and chew toy, squeak toy lifestyle, etc. So that'll give you an idea of where to start. And then figuring out how much money do you want to leave your dependents? Do you want to leave them over and above, or you just want to leave them the bare necessities? Um, and like I said, this is such a positive thing. Talk about death and dying. Will you require more or less insurance to meet needs as time goes on? There are policies out there, which we'll get into in a second, that actually decrease as life goes on, expecting as you pay off debts that you don't need as much life insurance. So they decrease as you age. Um, a lot of times at banks, if you buy their quote unquote credit life, they're buying it for the face amount of the loan to pay off if something should happen to you. It's going to decrease as you pay that loan down. So it's the same philosophy in life, and you can buy policies that do that. They're expecting you to have more debt in your 40s, less debt in your 60s. And so that's what they're going on with that. Um, when do you want to retire? How long can you pay on this? When are you thinking you need to have payments stop? Maybe you don't want to have to pay on your life insurance in retirement. So can you pay it ahead? Can you pay a bunch of payments? Can you double the payments? Can you do one payment? And all those things are a yes. So you can play with that if you don't want to have a life insurance premium in retirement. Which I can tell you, for a lot of people that we work with in retirement, they have all this life insurance coverage at work. They don't think about it, and then they start getting on a more fixed income and worrying about expenses. And the first thing they cut is life insurance, which sometimes is fine, but a lot of times leaves that spouse in a predicament for a period of time because they don't have the money to pay off things. Um, and they're left with payments until they can get things sold and things taken care of. And when you're older, it's just harder. So all those things to think in mind, that maybe you could pay on it till you're 65 and retire, or till you're 70 and retire. There are policies that allow that. um, how much can you pay? Again, we don't want to overextend ourselves. If you can't afford life insurance, then don't get it. But there's a lot of affordable options out there, so look at what your budget can handle and what you can do and do that. This just gives you an idea of average face amount of individual life insurance policies purchased. In 2002, there they were looking at about $120,000 of coverage. In 2002, sorry. In 2022, it's gone up to about 197, looking at $200,000 is the average face amount that they're looking at. Part of that reason for the increase, I think, is because of COVID. COVID made everybody realize that anything can happen at any time. You kind of sail through life and don't think about that, and that was came from left field, and everybody panicked. So all those things can make a difference. And then we have more people. So of course that makes a difference too. And cost of living has gone up. So things are more expensive. Um, you can calculate how much insurance you need a couple of ways. There's the needs range, which you look at your annual income and multiply that by 5 or 10. So if you're making $50,000 a year, multiply it by 10, look at a $500,000 policy. That's one way to approach how much life insurance do I need. There's the easy method, which I don't know if it's easy, but anyway, it's looking at a family will need 70% of your salary for 7 years before they can adjust to your life without your income if that's being missed. So again, if you're making $50,000, take 70% of that and multiply it by 7 years and see what you come up with. And that's just one easy way to do it. And that's not looking at other debts or anything else. It's just going with your salary, knowing that that's going to be missed. The book also recommends, if you're double income with no kids, make sure you can pay funeral expenses and half of debts. Now, sometimes you want to look at being able to pay all the debts, but the book says pay at least half of the debts because you're counting on that income making at least half of that payment or contributing towards that payment. So that's where that philosophy comes in. If you have a non-working spouse, you want to then take the number of years until the youngest child is 18 if you've got children. If you don't have children and you have a non-working spouse, then you probably need to go back to the figuring your income for 5 or 10 years to carry them on for that because they'll probably have to get a job, but it may take them a while. The family need method is more thorough, but it looks at employer provided insurance, what Social Security will pay, which is not much, so don't count on that, and then any liquid assets that you have that can be sold to provide an income. So that's what the family need method does. There are calculators, there's online calculators, there's a life insurance calculator that you can click on this link right here, and it'll take you to. I don't think it'll let me do this in the lecture. Yeah, it won't. Let me go yes. I'm sorry. But anyway, you can click that link on your own when you've downloaded this and do the or just Google life insurance calculator. And it kind of asks you those questions. Do you have any bills? Do you have this? Do you have that? And it runs you through that and then gives you an estimate of what you owe. I mean what you should get. So now who do you want to buy it from? Well, you may have a buddy that sells life insurance, which you can do. That's great. But think of the types of companies that are out there. There's stock life insurance companies and there's mutual life insurance companies. Um, Stock companies are stockholders, corporate run, et cetera. You know how those work. Mutual companies, well, we'll keep on stocks because we're in a stock company. So you can have a stock company that pays dividends or something like that. You have non-participating policies, and that means that it doesn't pay dividends. It's just going to participate. You're just owned by that company. So if the company pays dividends, you don't share in them. Mutual policies, fall into this participating policies. If you go with a like a Penn Mutual Life, a Mass Mutual Life, those are mutual companies. That's in their title, and that means that they're kind of like the credit unions are, where they're owned by the insureds. So you're an owner in that company. So if they pay dividends, you share in those dividends, and they can either be applied to your policy. They may send you a check. And there's a bunch of ways to handle that. So that's where that comes into play. And there's mutual life insurance companies. So now we know how much we're going to need if we use a life insurance calculator. We know which kind of company we're going to buy from. What's the next thing we need to think about? Well, the next thing is the type of policies. There's temporary life insurance company, which is considered term. There's renewable term. There's convertible term, and then there's that decreasing term policy that I talked about that goes down as you get older and your assets and your loans drop. There's permanent insurance. Typically, you're going to hear term and permanent, not temporary, because temporary sounds like, what do you mean it's temporary? I don't have it. Blah, blah. But usually, you hear term is used instead of temporary, but temporary is the definition. Permanent insurance is what you think of with a whole life policy, which means it has cash values in it. You pay in your premium, you pay in a set premium the whole time you own the policy, unless you set up something earlier. And as you pay in, of course, it's cheaper the younger you are. So they take what they don't need to pay the premium and put it in an account and let it draw interest. So it's like an extra savings account. From that extra savings account, you can take a loan if you need to. You can take a withdrawal if you need to. But just know if you deplete that extra savings account, you may have to start paying in more as your premiums go up. Because the theory behind having that cash value, and I'm talking with my hands, y'all can't see me to define this, but if you pay in, like your premiums say, or you're paying $40 in premiums, and when you start out, only $10 is needed. $30 is going into savings each month. So you build up your savings, it's earning interest, it may have dividends paid to it, et cetera. So it's growing. So eventually you're still paying $40 a month, and but it's now costing them $40 to cover your insurance. Well, that's fine. You pay 40, just not as much goes to the cash value. Then all of a sudden it's going to cost $50 a month. Well, you still pay 40, but they take $10 a month from that fund that's grown. So they're looking to offset those future premiums from that cash value. So if you withdraw that cash value for a loan and don't pay it back, or a flat out withdrawal, you may have to start paying in that extra $10 a month to continue that policy that you weren't planning on. So just keep that in mind. Okay, so you're going to take term for 100 is what that last slide said. So term or temporary. Um, it's only protection for a specific time. They have 5-year term, 10-year term, 20-year term, 25-year term, and 30-year term are the most common. which means you're buying insurance and it's the cheapest form out there because they're not trying to predict the future. They're not trying to go past the length of that policy. They're not trying to figure out when you're going to die necessarily. So if you looked at that table back where you were 25 and you were bought a 5-year term, they're expecting you to pay all those premiums. They're not expecting to have to pay you out. Now, anything can happen, but they're not expecting to. So because of that, the insurance is a lot cheaper. So a lot of people buy term. You'll hear the term if you're in the business world, buy term and invest the difference. You can do that. We'll get into that in a second. Um, but you can buy with term and then maybe set aside the difference if you want because you may decide you still need to keep insurance. 90, well, I'll say 85% of the time we see clients buy a term policy, they think they only need it for 10 years, they'll have everything paid off and then they're going to drop their insurance coverage. And that's fine. Well, that 10 years comes and they've decided, well, we've got another debt. We've been added onto the house. We've bought a boat. We've, done some things. So now they've got all this other stuff. So they need to continue that term. Well, number one, they're 10 years older. So it's going to be more expensive. Now, there is a feature in term policies that's called conversion, which means you can take that and convert it to a whole life policy. It's again a lot more expensive because premiums for term are cheaper than whole life, but it does do that. So, and with term insurance too, the big kicker is if you don't pay the premiums, there's no insurance. So if you miss premiums for a month or two and don't pay them, that insurance is gone. So you have to keep that in mind. Um, there's a multi-year level term. And basically it's the one that's looking at how to have insurance for like 20 years and they may have it's the same premium for the 20 years or that kind of thing. So it's the same premium for the life of the policy, which is nice. Decreasing term is the one I mentioned earlier where it's going to go down. So you start off with $100,000 and then they're expecting in 10 years you just need 50. It'll decrease to 50 and then your premium will adjust probably at that point also. Some policies have a return of premium. Term typically doesn't because of the fact they've calculated it to the penny to do that. But if you have monthly drafts and it comes out on the first and you happen to pass away on the fifth, they will return that unused premium. Um, so it works on all the policies that way. And if you outlive the premium, the policy, like people when the age was 100, or some of them are 90 or 95, if you outlive it, they return your premium and the face amount a lot of times. So you want to be sure of that. Reentry term, that's what you can do if you got a 5-year policy and now you need more and then you want to continue it, but you're still in good health. They'll let you just enter, maybe add on to that policy and make it a 10-year policy or 20-year policy at that same rate or a little higher. Renewable term means at the end of the time, you have a chance to renew that and continue it without a medical exam. Those premiums are usually a little higher because they're factoring that in there, but it's still an option that gives you some leeway at the end of the term policy to be able to renew it. Convertible term, that's where you can change it to a whole life policy or a universal life policy, usually whole life, without a medical examination. Or if it's been like a 30-year term, they may ask a few medical questions, but you don't have to go through like buying new insurance and all the paperwork that goes with that. So basically, remember, term is for a specific term of time. Okay, what's whole life? Well, whole life can be called a bunch of things. It can be, but it's typically, just think of it as permanent. You're paying on it your whole life. Term, you're paying on it for a term. Whole life, you're paying on it your whole life. They also can call it straight life, cash value life, ordinary life, all interchangeable names, which are very frustrating in the world if it's not your field. And companies will call it a certain name. They'll come up with a new name that makes it sound like it's really good. So um, just remember that there's really only a couple policy types out there. And again, you pay the premium for as long as you live. It's your whole life that you pay that premium. Now you can buy, and I'll confuse the waters even more. You can buy like a 20 pay whole life policy where you pay high premiums for 20 years and then nothing. You can buy a 10 pay whole life where you pay 10 years of higher premiums and then nothing. So there are options if you don't want to pay on it your whole life. So just know that that's out there also. But in our class terminology, that's what whole life means. It has the death benefit and that savings account that I told you that's growing. It has that will pay out also on most policies. So if you want to keep the policy for a long time, it's a really smart thing to look at doing, for sure. Okay, so again, you can have a single payment policy, a limited payment, which we just talked about, so you could pay it for a period of time and then stop, which is kind of nice, especially if you know you want to have the insurance for your whole life. You're making hand over fist money right now. You might want to get that puppy paid off. So when you're in retirement, you don't have to make those payments, which really does help. Um, Typically, again, whole life works with the lower premiums, as I said. Then the balance goes into the savings account. Then the savings account pays the difference between the low premium and what your premium actually is as you age. They have what they call a variable life policy. And what that means is it gives you the option to have a fixed face amount, and then it gives you the option to um, vary your premiums to an extent. And it also can give you the option. A lot of them do. They get into the stock market for earning returns, and you can choose an investment account, trying to, have another place to outplay the market, outplay the rate of return, et cetera, that the insurance company's paying. Um, they're going to pay the minimum death guaranteed for sure. The thing on that is they're not guaranteeing what that cash value will be. So if there's a variation in that, or you get to flex your premiums, um, then they're not saying, well, we promise you that your cash value will be worth 120,000 when you die. That's not in there. They're just saying you'll get paid the policy face amount, and then whatever else is left over. There's an adjustable life insurance policy. You can change your coverage and premium payments while you're going through life and etc. You don't see as much of those, but they are out there. Universal life, when it hit the market a billion years ago, it was like the thing, and it still is the thing. The perk of it is it offers more flexibility and more control. And so the individual really, 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 really liked that. You can pay premiums. They give you a schedule. They expect you to pay premiums. They project out how much you'll earn if you pay the premiums. That has the savings account like the other cut policies do. But say you decide to go back to school and you can't afford the premiums. If there's enough in there to carry that policy, you don't have to continue the premiums. You can pick them back up when you have an income again. That was a huge, huge boon to the business because life insurance had always been fixed payments, period. And this gave them the option, if you've got enough in there, or you might just pay the minimum premium. You can ask the company, can I just pay the minimum premium, not this calculated premium? And they can give you a minimum premium for 4 or 5 years. We had a few clients through the years that used it when kids went to college or went to med school or did some big endeavor that, money was just, you only make so much money. We got to make it go everywhere, and they didn't want to lose their insurance, but they just really couldn't afford those payments, and Universal Life gave you that option. So it was a big thing. It is a big thing. Um Again, just remember, basically whole life is considered paying for your whole life. There are options out there that change that, but that's basically what it is. Universal life also is kind of this, they called it, how I just told you people say buy term and invest the difference. Universal life kind of gave you that option because it basically was term insurance, but then it had like an investment vehicle on top of it. So when you wanted to pay just a minimum premium, they figured out what is the minimum premium to keep that policy going. That's the term coverage. So that's where that would come into play. Um, Way more details than you want to know, I'm sure. But anyway, that's out there. If you have questions, of course, ask me anytime. Um, okay, so we know this now. We know whole life is for your whole life, term is for a term. There's variations and all that. So, what else do I need to know about life insurance policies? Well, there's other kinds. There's group life. A lot of employers offer group life. A lot of times it's tied with the health insurance. They get a perk with having that. It is term insurance. It's often fully paid by the employer. It may be a percentage of your salary. It may be a flat amount. Sometimes you're able to purchase additional. The employer may pay for $50,000. You could go up to 100 by paying additional amount. So there's some options there that are really nice. Group insurance is a huge plus, especially for people that might have a medical history, because you don't have to fill out a medical charge. They're doing the whole group thing. They're covering the whole group thing. They're not looking at you individually. It's for the group. They're rating the group. So you don't have to fill out, I, had a heart attack when I was 20 and I had appendectomy when I was 10, and you don't have to go through any of that stuff. So that can make your insurance a lot more affordable for sure. The negative of that is if you leave employment, probably the group stays with the group, but you might be able to carry it on your own. So that's something to keep up. There's endowment insurance, which we talked about that. Endowment contracts always paid if you were paid to 100 and didn't die, they paid you. But basically, what it's going to do is it's going to provide coverage from the beginning of the contract to a guaranteed specified sum, and then if you're living at the end, it'll just pay you out. So it may be you maybe could buy a 25-year endowment contract. So you find it anywhere, but you find it more so in like older people who want to buy like a term policy, but whatever, and they may have on there if they are 102, they'll pay them out or something like that. So you do find it, but it basically just means if you outlive the period that the coverage there, they will pay you what you put into the policy, the face amount of the policy plus that. They sell policies just for funeral or burial expense insurance. Um, and basically, it locks in your provider's funeral expenses. You can buy these typically at your funeral homes, and then it's supposed to lock in the cost of the funeral for current prices. We have found that those don't always work that way. My grandparents bought a funeral policy, planned their funerals, did everything, and then by the time they passed away, funerals were a lot more, and we had to pay some, but it wasn't a lot, so we didn't pay for the whole thing. So it did help. I'm not negating that at all, but just kind of keep in mind that it's not a if it is guaranteed, make sure it's in writing that's guaranteed. Irregardless, it's going to pay for my whole funeral. And I think they've adjusted that in modern times to kind of keep up with the cost of living. Credit life insurance, as I mentioned when we were talking about loans, the bank may tell you, hey, you need to have life insurance to cover this loan. They sell life insurance. And so you could just tack it onto your loan and pay for it, and then it pays off the loan. I would recommend, if you're needing to get life insurance to cover that loan, it might be cheaper to purchase it yourself than it is to the bank. Typically, those premiums are much higher than they would be if you go to an insurance company. And it gives your family some other kind of income. The credit life only ties to that loan. So if your loan's $4,500, they pay $4,500 and that's it. It doesn't matter what the policy was for. It doesn't matter anything. That just pays off the loan. Your family doesn't get anything except the paid off loan. But if you purchase a policy outside of that and say buy a $10,000 policy, it would pay off the $4,500 loan, and then it would turn around and pay your family, your survivors, the balance of that. So it's a little more advantageous to do that outside of that. But if you're sitting right there and you need it, you haven't done it, it's a good way to get something to at least cover it, and then you can always drop it if you need to, if you get insurance on your own after that. Industrial life insurance you don't see as much anymore, but it is out there. They used to call it debit insurance. It's also in times had the name of home service insurance. What it was basically is that it's like a debit card, debit payment. You collect a monthly amount each month, and it's basically just to cover funeral expenses or limited end of life costs. It's kind of fallen by the wayside. My dad's dad was a debit insurance collector, and he would go door to door once a month and collect a dollar, 50 cents, whatever it was from each person, that kind of thing. This was way back in the, probably 50s, I guess is when he did that, 1950s. And so he would do that and go door to door and collect that. And it's still out there. It's still a policy that's there, but it's just not one that's used very much because of the terms of it. You can usually get a term policy cheaper or something like that. This was again fell under the excuse me, whole life thing. I just sneezed. Fell under the whole life policy. You paid on it forever, and it basically then, like I said, just paid your funeral expenses or end of life. It wasn't a big policy that you paid to your family. Comparing life insurance premiums first, term life is lowest, whole life has the most expensive, and universal life is flexible. That gives you that idea. Insurance companies protect for, well, term life for a specific period or a term, whole life for your entire life, as long as you're paying the premiums. for the whole life. And universal life gives you a flexible premium, and it may give you a flexible time period also, depending on how you're paying premiums. Policy benefits: term life is death benefits only, the face amount of the policy, as they call it. Whole life is death benefits plus that savings account that's been building in your policy. Less any loan values. We always want to disclaimer that. And then universal life is going to be your death benefit and potentially the cash and the loan value there, but it's not guaranteed. Advantages: term life, low premium. It's usually you can purchase a larger amount for a low amount, a low output. Whole life helps you with financial discipline. It's usually a fixed premium amount for your entire lifetime. So you can, if you're a budgeter, you can budget that and know that that's what you're going to pay, period, the end. Um, and of course, you can have loans against your policy, et cetera, which the term has no cash that it's earning there. And then universal life is the most flexible. It can be a little more expensive, except in the fact that it has flexible premiums to keep in mind. It takes advantage of current interest rates. It can have a variable policy, a variable universal life that takes advantage of the stock market stuff. Um, and so it has the most, like I said, flexibility. Disadvantages: where there's an advantage, there's always a disadvantage. Term life disadvantages are premiums increase with age, and there's no cash value. So you buy a 20-year term when you're 20. At 40, it's going to cost more because you're 20 years older, and you've not got any cash value built up to help you offset the new additional premium. So that can be considered a negative or a disadvantage. Whole life, if you surrender it early, there may not be a lot of cash value there because it takes a little bit to build that up. So you may not get a lot back when you're thinking, "Oh, I'm done with this. I want to get out of it." Whole universal life is the same as whole life. It takes a while to build up those cash values, so you may just get back a return of premium and a little bit of change on top of that. So that can be a negative. Options too to consider: term life insurance may be renewable, which means you can renew it at a higher rate, but don't have to have a physical exam, and convertible to a whole life policy, but again, you don't have to have an exam. So those things are really important. Whole life may pay dividends depending on the company and et cetera. It may You may provide for reduced paid up policy. Sometimes when you've been paying in premiums forever, you can call the company and say, "Okay, I'm tired of paying premiums. I don't want to lose the coverage. I want to keep insurance. What if I just walked away at this point and didn't pay any more premiums? What's it worth to me?" And they'll a lot of times look at what it would do and lock it in and tell you that instead of it being worth $500,000, it's now worth $300,000, but you can have that for the rest of your lifetime and not pay any more premiums. So that gives you that option to do that, which is a nice perk too. And then universal life, of course, may pay dividends. It has a minimum death benefit that's going to pay irregardless, and then it may have cash on top of that. And it also has partial cash surrenders that are permitted in both whole life and universal life. And those are those quirks on there that I told you. If you had a big event or hit retirement age or something like that, a lot of times they'll pay out cash to you as a portion of the policy, so you can live on what you've been paying in on. So, is the life policy a contract? Yes, it is. Um, Policy reinstatement of a lapsed policy, if it has not been turned in for cash, is usually 1 to 2 years. So if you have a major event, don't think you want life insurance, and then go, I think I do. Sometimes you can apply back to reinstate that policy within a year or 2 years. They'll ask some medical questions. They're not as specific as a whole new exam. But and then they'll just want to see, are you filling this out on your deathbed? Those kind of questions. So they'll ask some things. There is a grace period with every premium. They allow you typically a month. So think of it as 28 to 31 days to pay. So if it's your premiums due July 1st, you have until till August 1st to make that premium payment before it starts getting into a lapse or pre-lapse stage or having a problem. Um, Sometimes policies will allow you to have what they call an automatic premium loan if they allow loans on the policy. So, say you don't make a premium payment, becomes August 1st. If your policy has that feature, it just takes out a loan on the policy and then pays the premium. So now your policy has a loan, but it's just for the premium payment that's due. So that kind of can be a nice perk also. There's a non-forfeiture clause, which means you keep accrued benefits if you drop the policy. So you surrender it. With term, there's nothing because there's no accrued benefits. But whole life, if you surrender it, you get your money, your unused premium back, plus you might get your savings account cash value back. Um, Incontestability. A lot of movies have been made for this for this clause right here. Incontestability. If the policy's been enforced 2 years, the and something happens, the insurance company cannot contest that. So if you take out a policy, and suicide is the biggest clause, if you commit suicide in the first year or the second year, they may not pay the benefits. If you commit suicide the third year, that's hit that outside contestability period, that's fine. If there was a medical issue you, will say, forgot to disclose, but they find it in the fourth year, they can't go back and charge you more for that premium because it wasn't disclosed, because they didn't find it in that 2-year period. So it gives a 2-year period for you to find out something, or the company to find out something, that they could, challenge and say, hey, I think you need to pay us more because you forgot to tell us that you are a breast cancer survivor or whatever. So, and again, there's that suicide clause. It falls in that two years incontestability. The reason that they have that in there is because they don't want people. Uh, the mind is such a an interesting avenue if you're contemplating suicide, and it's a horrible thing for anyone to have to go through. But the insurance company wants to be sure that this doesn't give you an incentive to want to commit suicide, thinking, okay, I'll take out life insurance, I'll kill myself, my family gets $200,000, life will be good. So they want to make sure that that's not entered into that thinking at all. That's why there's the policy to wait for 2 years and do that. Beneficiaries are who we need to name to receive our benefits if we should pass away. You can have a primary beneficiary. You can have somebody in case the primary beneficiary goes with you. You can split. You can have 5 beneficiaries. You can have 10 beneficiaries. You can have as many as you want. And so you want to be sure you list those, and you want to be sure you keep them current. A lot of times when young families are applying for insurance, they'll say, my spouse is my primary, my children, and they may name them, or they may use the term, and all children born of this marriage share equally. And that way, if they forget to go back and change that, they've taken care of that third surprise child, or the third and fourth surprise child, or whatever. Um, they don't have to have everybody's name on there, because if you just want to be sure you cover everything. Either that, or keep up with updating your beneficiary every year to 2 years to 3 years. We had a person that had their ex-wife on their policy for a long time, and we kept, every time we'd get a status each year, we'd kind of write them and go, and I just want to point out that, blah blah blah, still your primary beneficiary. They eventually changed it, but I just kept thinking, do you understand that your current, and they weren't currently married, but they had a current long-term girlfriend. Do you understand your current long-term girlfriend's going to be a little ticked when this comes around, and you're not going to care, but we're going to care. But anyway, it's a choice. I mean, it's your choice, and they may have discussed that. They never discussed it with us, but they may have discussed that and knew that. So you just want to be sure, if you're doing that, that you keep up with who your beneficiaries are, etc. Misstatement of age. Since it pays based on actual, I mean, it's going to charge you based on age. If they find out that you said you were 18 and you were really 22, they're going to only pay out as if you bought that policy when you were 22. That's a given in the contract. It's in the fine print. So, just know that you can't rip off insurance companies. They'll find you eventually. Trust me. They're like the IRS. They'll find you. You can borrow if there's a loan provision, borrow up to the cash value of the policy. There are policies out there that are considered second to die or joint life policies. These are basically were bought for estate tax purposes for sure. Benefits pass on to the spouse in anything with estate taxes, usually without any issues or problems. They pass on to children, and it usually becomes taxable at that point. So, second to die policies came around to help um, pay taxes, pay estates balances, to pay off loans, to pay those kind of things. A lot of times when the second person passed away. So a husband and wife might get a second to day policy, leave their kids or their trust as the beneficiary. And that way, when both of them have passed away, anything that's left outstanding that would pass on taxably to the kids, now they have this insurance that's tax free to help pay for those things that will offset that. Your policy may have a quote rider on it. It doesn't mean somebody's riding along with you, but it does sort of in the fact that it means if you skydive, as we mentioned earlier, or do something, they may add that on there to cover that. They also may add riders for having a disability benefit that just popped up, or they may have a rider for a long term care benefit. They may put something on there that gives your policy more than just it being a life policy, it gives you a few more options on there. Sometimes with accidental death, they will pay double because they'll always ask on the forms, is it a accident? Was the result of this due to an accident? If it is, it's what they call double indemnity. And there is an old movie with that that's really good. But anyway, it's basically means that they'll pay twice the face amount of the policy if death is as a result of an accident. They usually have cost of living protection in there, or they can have it, but they usually do. They may have the accelerated benefits where you get to take it out before you actually pass away if you have a major health event. So there's some perks in there that it's not just only paying when you die. So just keep that in mind. Okay, so now where do you go to buy it? I mean, you've got all this, now you want to do it. How do you do that? Well, look at private and public sources both. Look at insurance companies and their rating. There's a BESTS rating system out there that publishes a manual and rates the insurance companies based on uh, prior performances, prior payouts, current payouts. It also looks at their asset to liquidity ratios. It does all the things and then gives them a grade from an A to a C, I think, and an A plus plus and A minus minus and all those things. But it kind of lets you know how strong the company is. Because again, a lot of insurance companies will get bought up or eaten if they get into financial trouble. But you want to be sure that you're buying from a reputable company and somebody that's a good company. So you want to be sure you do that. Talk to friends, colleagues. Google, of course, is a great way. The AM Best is a good way to look at it. And this is you can just see how they're rating. Um, Basically, they're non-viable if they get an E or an F. They're very weak if they get a C or a D. Um, they're below average with a C plus. So you kind of are looking for the A to B category in my mind. These companies at the bottom of this, the C, Ds, and Fs, are probably on their way out or on their way to be gobbled up. And not that there's anything wrong with being gobbled up. It's just that then your policy will change and your premiums go somewhere else and someone else takes care of it, etc. Choosing your agent. You want to have an agent that's available when you need them. That's a very important feature. Um, your agent may advise you to have a financial plan. They may have ways to help you with that. Do they pressure you? Are they high pressure sales? If they are, I kind of have a tendency to cow down and move away. I'm not a high pressure person and I don't like that. Does your agent keep up with changes in the field? Do they just sell it and leave you alone, or do they keep up and say a lot of, especially in the property casualty field, will call you and say, "Hey, we need to have a, annual meeting." You can also buy life insurance from your property casualty people like Allstate, State Farm, etc. And that may be the place that you want to do it. Sometimes, again, because you bundle, you get a discount, so it might be worth doing it. And then, is your agent happy to answer questions, or do they feel like you should know this, or they don't know it? So you just want to be sure you kind of, especially if you're going cold turkey, figure out what they really know. Um, the price of a policy, we've kind of covered this, but it's affected by the company's cost of doing business. Again, they have to pay the lights, they have to pay the electricity, they have to pay the rental on the building or the mortgage. So they got to cover their costs and salaries and everything else. There's also the return of the company's investments. If they're a strong company and that A plus thing and getting stock dividends or paying interest all the time, that can make a big difference in your policy too because they're making money on it. Um, the mortality rate the company expects among policyholders, you're not going to really know that. That just lets you know that that's what companies are looking at. If they get into a group or a logistic area or something where there's a lot of deaths, they may not write for that town or that feature. Policy features, of course, can make the policy more expensive if you've added on riders for accelerated death benefits or you skydived. All those things can make your policy a little more expensive. And of course, health issues can make a difference too. Competition among companies with comparable policies. That can help with business because I'm always one that thinks competition is healthy, but you want to be sure if they're competing that they're competing on the same policy and the same coverage. Sometimes they'll say they will, but they're not. Underwriting, I think I told you they're the person that are looking at the risk of you passing away, when you'll pass away, etc. They're looking at age, gender, health, occupations, hobbies, trying to figure out what the premium should be to charge that. So looking at policy costs, what do we do? Well, you can use the interest adjusted index to compare policies. That's great. Take the time value of money, do all this kind of stuff, and you can do that. And there's a quote, there's etc. out there. I pretty much, if I'm looking at comparisons, I look at the exact same policy. Now, companies may have different perks or something like that. If they have different perks, list them. And I'm of course I'm a spreadsheet chick, so I'm going to put it on a spreadsheet. I'm going to say company A cost me $20 a month, but they also have an automatic payout if I double indemnity, and they automatically pay out if I have a major illness. Company B doesn't have those two features, and their premium is X a month. And company C is X a month and has one of the features but not both. And that way I can kind of look and see, are those two features worth the premium to me? Is that premium cheaper? Well, then probably it's worth it to me. If it's more expensive, are both those features worth it to me? So it's just kind of those things to look at. I also need to tell you, insurance agents are a pain, or can be, for getting a sale, and thus the websites you might try to look at, like if you go to well, you probably noticed if you've done insurance, you go to some of these insurance sites and they say calculate how much you think you need, and then within sometimes before you even hit enter, someone's calling you to try to make you a sale. That again bothers me. So I prefer to look at things that have free, no obligation premium comparisons. So I look for those things. Those things are term quote, rely quote, quick quote, and select quote. They don't have any obligation. You're not committing to a company. You're literally looking at comparison issues of pricing of that kind of thing. So that to me is more expensive. Okay, so you get your policy. What do you do with it? Well, you're going to have an application period. You're going to have medical history that you've provided. There's no physical for group policies. There's just an enrollment card. I'm going to tell you, you need to read every word of the contract. Most of you won't. At least read the headlines of each contract just to see what's in the policy contract. After you buy it, you have a 10-day free look period to change your mind. So if you buy it and think this is wrong, you have 10 days to get out of it without any questions asked. Give your beneficiaries a copy of your policy, a lawyer a copy. Of course, if you can scan it in or have it digitally, that's great too. And then after you have your life insurance company and your policy, um, we've done that. Okay. Get a dated receipt from the post office for the agent, especially if a premium is late or close to being late or being paid. If you're paying it online, you'll have that receipt. You don't have to worry about that. Some of this is a little antiquated that the book covers. A company must return your premium within 30 days from the date you return the policy if you turn it back in. So they can't keep your money and play with it for a year and give it back to you. They have to give it back to you within 30 days. So just know that you have some rights in that also. Um, Death and survivor benefits, basically, of course, you're trying to look at covering immediate costs plus maybe long-term costs like education and stuff down the road. Um, so it's an important thing to look at. Because of that, usually when you pass away and your insurance is going to be paid out, there's options. You can pay a lump sum payment. You can pay. They may send your beneficiary a checkbook, and they can just write checks from that account. It's an interest bearing account as they need to pay things depending on what it is that's going on. If the company holds the money, interest is earned. Um, there can be equal installment payments. They can choose to do that. Some of these options you can choose when you sign up for the policy. If you know your beneficiary's spending habits and you want to control that, you can do that too. Or they sometimes can convert it to an annuity and pay out the $1 million policy over their lifetime and then do it that way. So there are options there that are kind of nice to give you. It's not just, and of course, when you leave children as beneficiaries, I always try to tell the parents, we don't hand your child a check if they're 10 and say, "Here's the toy store. Let's go shopping." There are safeguards in place to be sure if a minor's given money, who how it's handled, etc. So there are things in place to help do that. Um, what if you want to switch policies? Are you still insurable? Keep that in mind. um, Maybe check one of those quotes, fill in all your medical information, see if it how much premiums are going to run. If you want to change companies or change policies, if you change companies and if you change policies, there's going to be questions asked. Now, if you change companies, you're going to have to fill out a whole new application. If you change policies in the same company, there's still going to be some medical questions asked. So you just want to make sure that you meet the requirements and don't set off a red flag. Know that the older you are, the higher your premium's going to be, especially in a term policy, but even in the universal life, the older you are, those premiums are higher. That's why you lock in those premiums in a whole life, et cetera, to try to cover that. And then, are all the provisions in the new policy the same ones that were in the old policy? Or are you losing some things? And make sure that you're okay with losing those things. So just keep in mind that it's it's a contract, it's an investment. You want to be sure that you're taking care of you and taking care of your loved ones with that, and not making decisions, based on, well, this looks really neat, I want to do this, or this sounds like cheaper and I want to do that. Make sure that it really is. Okay, that is it. If you have questions, of course, give me a holler. I appreciate your time, and I will talk to you later.